Welcome, everyone. I saw a lot of states represented, so appreciate everyone's attendance. It looks like from DC all the way to California and everything in between. So excited to have a conversation with you all today. We've invited the best and brightest from both the S&P side as well as the CoBank side. So without further ado, I thought I'd take a few minutes to just briefly give an introduction for our two presenters or two speakers. For those that don't know me, my name is Tamara Reynolds. I'm a managing director for CoBank's electric distribution division. I work with co-ops across the south part of the country on the electric distribution side. So I'm also pleased to welcome David Bodek. He's a managing director for S&P Global Ratings. David is responsible for public power and electric ratings and speaks frequently at conferences. He discusses credit opinions with both utilities, their financial partners, and their investors. He also actively monitors credit ratings for a portfolio of very high-profile electric cooperative and public power entities. And he also develops rating methodologies for S&P. So excellent knowledge and skills and expertise here from S&P. Also, JT Parker, he is our infrastructure credit manager at CoBank. He's responsible for leading a team that focuses on underwriting and credit administration across 5 different infrastructure groups, including electric cooperatives and G&Ts. And so pleased to welcome both of these gentlemen. I think we've got some really good content for you. I would also encourage questions along the way, as Paul said, so please don't be shy. And with that, I will turn it over to David.
Good morning, everyone. And it's really a pleasure to be here with you. I want to thank CoBank for inviting S&P to participate in today's session. Tamara, are you going to lead off with questions?
Yep, absolutely. So David, in January, S&P published a sector view or an outlook that focused on public power and electric cooperatives. Can you talk a little bit about that analysis and some of your findings that you summarized in that sector view?
Sure. S&P has negative outlooks on the public power and electric cooperative sectors, as well as the investor-owned utility sector. And the theme behind these negative outlooks, I think, can be summed up as utilities need to repair what they have. There's been much climate change damage to utility infrastructure over the past few years, whether it's been wildfires or polar vortices or hurricanes. And so there's a lot of spending there. And then utilities also need to build for the energy transition and for load growth, such as data centers and for beneficial electrification mandates. All of these add to the costs that utilities are going to face. And we see these costs as having pressures that could adversely affect credit ratings. Having a negative outlook for the sectors doesn't mean that we're going to downgrade utilities across the board, but rather it suggests that we have a bias or a negative bias for utilities because we see a heightened level of vulnerability for higher costs. If you look at the slide and you see the ratings distributions I'm showing there, you can see whether it's the not-for-profit utilities, which include the electric cooperatives and the public power utilities, or the investor-owned utilities, you can see that the ratings are solidly anchored within the investment grade rating category. And this is very significant. If you look at other industrials, the yellow bars, you could see that they're deeply speculative grade ratings. That is the preponderance of ratings within those sectors. And whether it's investor-owned utilities or public power utilities or electric cooperative utilities, they have the benefit of whether it's a board that sets the rate or a city council or a regulator that sets the rate. There's a framework for cost recovery, but when you look at, let's say, Red Lobster that just filed bankruptcy this week, or other entities that file for bankruptcy, they don't have a vehicle for cost recovery. But even with that vehicle for cost recovery, we see increased pressure as utilities are facing a turning point in terms of taking care of existing infrastructure and preparing their systems for energy transition and for load growth.
And David, you mentioned, it's not a broad stroke downgrade across utilities with a negative outlook. And certainly it's utility specific or co-op specific. But are there certain thresholds you're looking at in terms of these pressures, both from repairing the existing systems and also kind of the pressures from preparing for the future, for the energy transition and load growth?
Great question. So in terms of the thresholds, we're looking to see both qualitative and quantitative factors. From a quantitative point of view, we're seeing the cost of added debt to add to infrastructure or buttressing existing infrastructure, and that's pressuring margins. We're also seeing that at quite a number of utilities, those who set rates, whether it's a regulator or it's a board or a city council, that there's somewhat of a reluctance to raise rates given the economic environment that we're in. And so that has a qualitative aspect, that there's less of a willingness to raise rates and keep them in lockstep with rising costs, which then has a quantitative component that dilutes financial metrics.
Makes sense. Thank you.
Yeah, JT, from your role and perspective at CoBank, is there anything that you might add to that around the headwinds that he's spoken to, sort of the high level summary, or anything that you're observing that maybe supports that sort of trend?
Yes, certainly a lot of rate pressure. I think David's got a slide later in the deck here that shows inflation, general economic inflation versus industry specific kind of rate pressure inflation. But yeah, a lot of demand on kind of the equipment, the people, the grid that maybe we haven't seen historically. We've seen certainly over the past couple of years. And then going forward, David mentioned kind of the energy transition plus load growth. Those are two kind of potential pressures as well from an affordability standpoint. Wells Fargo just released a paper that said they think data centers will represent 15% of use of electricity use by 2030, which is a pretty staggering number, considering it's essentially nothing today. An interesting part about that, for co-ops at least, is a lot of that use, they bifurcated it by training the models and inference, users using the model. A lot of that will be training, which can occur in more rural areas. So that may be more well positioned for co-ops. And then one kind of fun fact I found from that deliverable was, they said, the next iteration, really where a lot of data will be consumed and a lot of electricity will be consumed, will be with generated videos. So you ask a ChatGPT or whatever platform to generate a 60-second video. That's supposed to or expected to use about a kilowatt hour of energy. So that'll be interesting, I think, to monitor going forward. And then from an affordability standpoint, certainly seeing the rate pressures from the G&T co-ops and from the electric distribution co-ops. I was looking at the accounting and finance handbooks. I think we showed a 14% wholesale increase at the G&T level from 2019 to 2022. So be curious to see when that handbook comes out next month or so.
Yeah, that's interesting that you note that. Regarding the rural data centers and kind of the learning aspect or the training aspect, is there any indication about that being really load factor intensive relative to the other kind of data centers? Did they mention that?
I'm not sure if they did, but my assumption's always been they are pretty load factor intensive, and they are edging out into more rural communities, which again I think will be kind of a tailwind for potentially for the co-ops. And I know that we have the Power Plays podcast. We have a podcast on the digital infrastructure side as well, called All Day Digital, and we had the most recent episode kind of talked about that fact. So I encourage people to listen into that as well.
Good point. Why don't we switch gears to our first polling question and kind of keep the audience engaged here. David, I'll let you switch the slide. So polling question number 1. So for the folks on the phone or on the WebEx, feel free to answer. How many new electric and gas rate cases, including limited issue rider proceedings, were filed in 2023? A, 26, B, 86, C, 156, or D, 356? Give it a moment there. And while we do that, I think one question I would maybe pose to David as we're thinking about it. It seems that S&P has a negative view relative to maybe other raters within the industry. Any thoughts or as to why that opinion maybe differs from, say, a Fitch or someone else?
Sure. And if I could switch slides, or I'll just wait a moment.
Yep, we can wait a moment. So looks like results are showing almost a dead tie between C and D with a lot of no answers, which is probably I have no idea. The correct answer is actually C. So I would applaud you guys for that, which is quite a few. Any comments or thoughts on that, JT or David, just with the number that you're seeing there?
Yes, I have a few thoughts. JT, if you'd like to go first, I'm fine with that, but I have a few thoughts.
Sure, yeah, I can go first. I think in general, we're seeing a lot of activity because of these rate pressures, right? It's forcing the utilities to go back to the commissions and request increases maybe more frequently than historically. In certain states and jurisdictions, we're seeing more challenging regulatory kind of constructs or regulatory decisions too, which again forces you to go back. I'd be curious on what the quantitative data is over time, but I suspect we're seeing more filings now than we have historically.
So to build on your response, JT, the number of filings is up significantly. I think if we turn the clock back a little bit and think about national electric sales, it's really been essentially static over the past decade or so because of energy efficiency gains and the like. And from an investor-owned utilities point of view, they had a depreciating rate base because they couldn't justify building new generation when electric cells are static. And now the energy transition comes along, and here are opportunities to invest in renewable energy, to invest in transmission projects. And they have the opportunity to file new rate cases to increase their rate base and get better returns than they had of late. And I think that that's going to be a driver of these continued rate filings. The magnitude of the infrastructure needs to support the energy transition are just tremendous. Princeton came out with a study indicating trillions of dollars to upgrade the grid to support all the renewable projects throughout the nation. And I think that's going to continue to be a driver. And even with the rate relief, leverage is going up, and that is pressure on the ratings for the investor-owned utilities as well as the electric cooperative utilities and the public power utilities. And Tamara, to go back to the question you were asking while the polling question was up, you asked why is S&P negative while other rating agencies might not be negative. So I can't speak specifically to what the other rating agencies are thinking, but I think that this slide is very telling. The inflation for electricity prices has far eclipsed the consumer price index over the past several years. And while the rate of growth among electricity prices has slowed considerably, prices have not retreated at all. So we see customers as facing a lot of pressure in terms of the electric bills that they have to pay. Some have said that, like, if you look in this range, some of this is Russia going into Ukraine and what that did to natural gas prices. However, if you look at the fact that natural gas prices have collapsed and they're continuing to go down, but at the same time, electricity prices continue to go up faster than the broader consumer price index. This presents an issue for electric utilities and those that set rates for electric utilities and affordability issues. And we're seeing increasing instances among both large and small utilities. We're seeing increasing instances of delinquent accounts or uncollectible accounts going up because consumers are facing this type of pressure.
Yeah, I think one thing I'd add there, David, is there's a difference certainly between the co-ops and the IOUs in terms of rate motivations, for example. And on the co-op side, I've heard G&Ts describe themselves as shock absorbers for their systems. Maybe they have deferred revenues, rate stabilization plans. They've got different tools, so to speak, to prevent material rate increases all at once versus a little bit different motivations on the IOU side. And what we're seeing on the IOU side is, a lot more regulatory assets, which basically are just deferred costs that have to be passed through or expected to be passed through at some later date. So we're following kind of how big those regulatory asset balances are, what the risk of those potentially being disallowed or what the recovery timeframes are, but all those things kind of build up over time and add to the rate pressures.
And to that point, JT, we're seeing a number of cooperatives that have relied on a number of G&T cooperatives that have relied on deferred revenues for a number of years because they're hearing from their members that the inflationary pressures that are pervasive in the economy are weighing on customers, and they're trying to soften that blow to the customers. Over time, though, we're seeing that deferred revenue balances are being depleted, and at some point, the utilities are going to face the music, so to speak.
That's great. David, why don't we hop back to the slide where you're focused a little bit more on borrowing costs and sort of the expectation for investment there.
Sure. So in terms of investment, I mentioned the Princeton study of trillions of dollars to improve or upgrade the transmission grid. Just to give an example of utility, Los Angeles Department of Water and Power and Municipal Utility, they're saying that to get to fully decarbonize by 2035, they anticipate 60 billion of additional costs. Some of it is direct investment, some of it is PPAs, some of it is additional operating expenses. But what's significant about using the Los Angeles Department of Water and Power as an example is that here's a utility that already is about 50% carbon free, and yet they have these tremendous costs in their forecasts, recognizing that not many utilities are as large as this utility. So on a proportional basis, they'll be smaller, but most utilities are more carbon intensive, and that's going to create a lot of pressure for utilities as they invest. From an investment point of view, we see that the materials such as iron and steel that are critical to decarbonization investments, the prices are up substantially. Maybe they've abated a little compared to the highs, but they remain very elevated as to where they were just a few years ago. Borrowing costs are very high for utilities. I was speaking with one of my colleagues in the merchant space yesterday, and he shared that PPA costs are greatly inflated for renewables. Many speak to the fact that or the conventional wisdom is that renewables are becoming cheaper and cheaper, but the PPAs are becoming very expensive because of the embedded costs, borrowing costs associated with that. And we see all of this weighing on consumers and on those who set rates, that they're taking a step back and asking, can consumers afford to support the increased rates? And we see that this is truly an issue. During the personal savings rate has been going down. The peaks here are during the pandemic, the stimulus dollars and the absence of places to spend money when people weren't traveling or stores were closed. But the trend line is below where it had been pre-pandemic, and we see that as having a chilling effect on rate setting for electric utilities. And we're also seeing this show up in delinquent accounts, both large and small utilities. Just like as a background, credit card delinquencies are up, auto loan delinquencies are up. So consumers are hard pressed to pay for the energy transition and the load growth needs that utilities are facing. Perhaps I'll turn to JT. He had flagged this data, which I think is very interesting as well.
Yeah, and David, I'm curious on kind of how much you think the consumer can ultimately bear with kind of the recent trends. But yeah, this is something that we've been monitoring, the residential electric utility arrears or the amounts that are unpaid. And if you look, I think this goes back to 2021. If you look even back to 2019, pre-pandemic, because in the $8 billion range, so almost doubled over the past, 5 or so years. And then they've got the note there around that $14.5 billion in amounts owed, represents approximately 7 or exceeds 7% of utility revenues. So it's growing, and it's already kind of a significant number that the utilities have to work through with the commissions and the ratepayers.
In terms of your comment about how much can the consumers bear, I think it's very interesting to look at a few very large public power utilities. Salt River Project, which serves in the Phoenix area, has almost 1 million customers, a very large utility. They've deferred about 400 million of expenses over a few years. And they've done so because of concerns of affordability. Los Angeles Department of Water and Power that I cited before has a very high percentage of customers on payment plans, and yet they're facing this $60 billion number that I had shown you. And then in San Antonio, Texas, City Public Service also has a very meaningful number of customers on payment plans. We've had a number of downgrades of smaller utilities where they're the city councils or boards that set rates have been reluctant to do so because they know that consumers are squeezed by some of the economic indicators that we've shared with you this morning. And because they're not raising rates, we're seeing financial metrics are eroding, and it has led to rating downgrades. Some of the larger utilities that I mentioned tend to have more robust financial metrics in terms of debt service coverage and liquidity to shoulder some of the pressures that they're feeling in terms of delinquent payments, and to be able to defer expenses as Salt River Project has done, or call upon deferred revenues as JT has cited.
You guys, one thing I would probably throw in too is I would not say that we've necessarily seen the same trends with electric distribution cooperatives where you've seen sort of the successive receivables growth over that time. Yes, you saw it a little bit during the pandemic, but I would say generally speaking, it's not as prevalent as you might see with IOUs. And I think that goes back to the type of ratepayers that you have at a distribution cooperative. So I think there's one aspect there. And two, I think that there are, less members where that's really a challenge. So I think that's a positive when we think about the industry. And I guess I would circle back a little bit. Earlier, we spoke to growth and the potential for challenge there. And I would just note also that, I think that's all predicated on having a smart approach to taking on new loads and thinking through how those are paid for. Co-ops in general have done a great job of really thinking through how do we manage large loads like oil and gas or crypto mining or even now with data centers. So I think we're not saying that growth is negative, but we're saying that there's the potential for the challenge to exist if it's not addressed correctly. So I want to make sure we clarify that a little bit.
Sure, and I'm glad you raised those points. I think, so just very briefly, I think sociologically we hear from cooperatives that farmers pay their bills, and I think the mindset is that they pay cooperatives pay their bills, but at the same time, if you look at bankruptcies in the G&T cooperative space, there were at least about a dozen in the 80s and possibly into the 90s. So it doesn't always bear itself out, and we hope to see greater stability. In terms of your comments, Tamara, about the data centers, so we see that the distribution cooperatives or even the G&Ts that are being approached by data centers, they're saying, listen, we're not going to put in the infrastructure for you, such as the substation or the transmission line, because if you should walk, we don't want to be left holding the bag, or we need a guarantee. We might put in the transmission line if it benefits our customers to another extent. We can justify socializing those costs across the customer base. In terms of generation, it can be more of a challenge because it's difficult to add generation incrementally and achieve economies of scale. It's more difficult to add a generation unit for a particular customer, and if there's generation in addition, the data center might have the financial wherewithal of Amazon or a Google might have the financial wherewithal to support additional costs of new generation, but are they going to support the entirety of a new generation add? And that's where utilities might be called upon to look to their existing customers to pick up some of those costs, or alternatively to say to the data center, you know what, we're glad you thought of us, but this just doesn't work for us economically.
Yeah, great points.
I agree. I think it's a tailwind if executed properly and for the utilities. So, and I think there was a recent development that was interesting to follow in Pennsylvania with the nuclear plant and Amazon actually acquiring the data center campus that's adjacent to the nuclear plant up there, which has both a utility owner, a co-op owner, and then a IPP owner. So that was an interesting development and ones where we may see more of that type of movement.
Yeah. Before we forget, let's pop back to slide 14 so we make sure we capture that polling question. I want to think a little bit about this aspect. How much funding is available for electric cooperatives through New Era? A, 1.1 billion, B, 5.8 billion, C, 9.7 billion, or D, 15.1 billion. While we're waiting on that, JT, any views on what we're all seeing, maybe from the co-op side on New Era and kind of what they're looking at from a opportunity standpoint, or how CoBank's thinking about this?
Yeah, and I'm on the credit side, not a sales guy. Maybe I'll put my sales hat on here. I think CoBank's extremely well positioned to meaningfully provide capital to these types of projects. We view it as a significant kind of tailwind and positive for the industry. The direct pay aspect, the transferability aspect, you can stack, credits and grants on top of each other, which just makes these extremely attractive from an ownership standpoint. When historically, the co-ops have been forced to buy more through PPAs. But yeah, I think there's opportunities for bridge financing. I think there's opportunities for permanent financing. There's been a ton of interest. So I know we've got the poll results now, but yeah, I think there was $46 billion of letters across 160 letters. So that tells you kind of the interest and the economics of how it makes sense from a cost standpoint and can help curb some of these pressures we've been talking about, right, from an affordability standpoint.
Yeah, exactly. And just from a polling answer standpoint, 62 of you have been paying attention when we talk about all the money that's out there. 9.7 billion related to New Era. When you add in the PACE piece, that adds another $1 billion. So, and that's kind of focused on electric cooperatives and public power. So I really wanted to spend some time on the New Era. David, anything that you might want to add around just we touched on it earlier, inflated borrowing cost and kind of what that looks like.
Sure. So as JT had mentioned, having the access to the New Era and PACE monies is really fantastic for the cooperative sector because it helps mitigate some of these high borrowing costs that they otherwise might be facing. But because the costs of materials are up substantially, it will be interesting to see to what extent have these higher material costs, higher labor costs consumed some of those New Era and PACE monies.
Yeah, great. JT, anything that you might add related to just what we're seeing when it comes to decarbonization and, how people are thinking about the planning aspect of this? How do they take into account not only the New Era stuff, but how are they thinking about investments in assets and longer term sort of use?
Yeah, I mean, I think especially for the co-ops, reliability is forefront, right, from a decarbonization standpoint, reliability and affordability. So, we've seen a lot of coverage around the EPA's new power plant rule, a lot of response and legal response. I think I was listening to along these lines in our ACA podcast, and Mac McLennan from North Dakota was talking about kind of the impact of some of these rising costs, the debt costs in particular, on one of their carbon capture projects. So that, yeah, I think certainly there's challenges associated with the decarbonization relative to kind of the framework of the G&T in terms of wanting to focus on affordability and on reliability. So yes, it's a challenging time to be making long-term investments with all these kind of external factors, regulatory factors, demand factors, economic factors. So yeah, certainly appreciate that.
One question that came in, and I may have a view on it, but I'd love to hear y'all's thoughts on it too. We've sort of seen an evolution to some degree in some areas of the country on residential rates and including both energy and demand charges. What are you guys seeing in that space? David, do you even get into that level of detail, or how are you sort of seeing that manifest itself? I think you're on mute. I knew we would say it once.
Okay, sorry about that. In terms of the split between demand charges and the variable costs, we've seen some utilities moving more to a fixed component of the rates, particularly where customers are embracing rooftop solar. We're somewhat indifferent to the mix. We're looking more at cost recovery, but we do know, having said that, we're somewhat indifferent to the mix. We know that at some cooperatives, for example, it was probably about a decade ago, that not on the residential side, but on the wholesale side, that Tri-State Generation had changed the balance between its variable and fixed cost, the demand charge. And we know that that was an issue for its ratepayers. But conversely, Old Dominion Electric Cooperative rejiggered its mix of fixed and variable cost recovery. And it wasn't an issue. On the distribution cooperative side, we know that utilities are very actively trying to manage their demand charges. For instance, Old Dominion member Delaware Electric Cooperative has instituted a program some time ago called Beat the Peak. And so they're basically trying to signal to their customers that during peak hours, maybe you can turn down your air conditioner or not use appliances. So there is a sensitivity to that in terms of controlling rates.
JT, anything to add there from your view?
No, I think there's been a lot of, renewed focus on rate design, given the pressures. And I think probably in large, we're seeing more shifts to demand costs versus variable costs. And even on the regulated utility side, you typically want to remove yourself from the impacts of weather and the impacts of energy efficiency. And they do that through what's called a decoupling mechanism. So a lot of times on the utilities, the regulated utility side, they're looking to employ decoupling within their rate structure just to have a more kind of stable source of cash flow and financial stability.
Yeah, I think from our perspective, I've seen it, like I mentioned earlier, it's popping up in different places. I know Missouri, we've seen quite a few co-ops move to sort of that three-part rate design and look at how to sort of signal, demand in a way that's meaningful to the ratepayer. Other areas, it's not important, or it's not something that they're seeing from their power provider, right? So it's not something they can easily sort of translate to the end consumer. David, switching gears, I think there's been some, thought and maybe some previous comments around extreme weather events and sort of the risks there that we're seeing just when it comes to financial burdens that co-ops are having to manage, thinking through FEMA and its long-term sort of impact or contributions. Any thoughts or views on how utilities might need to be thinking about resiliency and system hardening, and what does that look like when you start thinking about the financial impacts?
In terms of the financial impacts, I think we can look to Brazos Electric Cooperative and the toll that Winter Storm Uri took on that cooperative, and it's Rayburn also felt very severe financial effects of Winter Storm Uri. And in looking at the sector generally, well, also, it's not just Winter Storm Uri, Winter Storm Elliott, and the increased instances of polar vortices. We're seeing more frequent, more severe storm events. It's affecting more and more utilities across the country, whether it's hurricanes or wildfires or polar vortices. And We're looking at the susceptibility of utilities to these events. We're looking to see, do they have insurance? Do they have sufficient liquidity? Are they in a high-risk fire zone? What kind of storm hardening are they putting in? Are they putting in appropriate weatherization? Sometimes even if the utility weatherizes its facilities, it remains beholden to gas systems that aren't adequately weatherized, and that could interrupt the supply of gas to generation facilities. We will ask whether the utilities have dual fuel capabilities, and if they have oil on site, how much oil, how many days can they go with oil on site if gas deliveries are disrupted due to freezing. So this issue really has come to the fore, and it has adversely affected to a great extent Brazos, Golden Spread, to a lesser extent many others, but it's very much on our radar screen. And looking to the IOU sector, Pacific Gas and Electric, or Excel Energy or Hawaiian Electric, also outsize impacts.
Yeah, I was going to mention the wildfire piece, just given the potential for overwhelming liabilities, that could be substantial relative to equity. And what we've seen is a lot of that's been on the regulated utility IOU side. Basically every entity that's listed on the slide there, but co-ops haven't been completely spared historically, and there's the potential going forward. We in Colorado obviously are in a wildfire prone territory, and it seems like in the summer we get alerts just about every day about higher wildfire risk. So certainly something that we're watching locally and across the country.
Yeah, JT, when you think about, let's just say the last 5 years, we've seen a number of instances here. I think in 2020, we saw an ice storm and a hurricane and a fire on the same day, or it was very close together. So there's things that tend to correlate. But when you think about, how that impacts utilities, what are we thinking about from a banking perspective, especially around the insurance side? Any thoughts or feedback there?
Yeah, I mentioned the liability around wildfires, but even I think David mentioned liquidity, that could be impacted, and financials by extreme market stress, like we saw $9,000 prices in Texas for an extended period of time per megawatt hour. So, and he mentioned a few of the co-ops that were significantly impacted, and a lot of those cases, there were securitizations or regulatory assets created, right, where you're passing along those costs over extended periods of time where the impact isn't felt immediately. As we see more of these events, there's concern from a banking perspective that you start to stack these regulatory assets or these securitizations, and it becomes almost unabsorbable, or it reduces your flexibility to adjust rates going forward. So the cumulative impact versus just kind of the one-time impact is something we're looking at. And then, from an insurance perspective, certainly we've heard from the utilities that it's a challenge to obtain kind of reasonable premiums. It seems like the last dollar of insurance coverage on a marginal basis is a lot more expensive than it was historically. We haven't heard of the inability to obtain kind of adequate insurance. It's just at what cost and at what point does it become cost prohibitive.
And the point that you raised about securitizations is really very important, because for Rayburn, they didn't have market access to capital, and getting the securitization legislation was really critical to them. And whether it's Rayburn or others, one of the areas of inquiry is, even though this securitization is off balance sheet and spreads out the costs over time, there is a cumulative effect, as you referred to, JT, in terms of customer bills, like how affordable are customer bills. When customers get their bills, they don't parse it and say, oh, this much is securitization charge and this much is the charge for my distribution cooperative. They look at the bottom line on the bill and ask themselves, am I well positioned to pay this? Can I afford to pay this bill? And the rate making flexibility and the affordability remain really critical issues.
Yeah, and the securitization is important too, because it allows them to access lower cost capital, which could mute the impact of the line item on your bill over a long period.
Great. Why don't we switch next to the polling question number 3 before we kind of get into the area on cybersecurity.
One moment.
I think it's slide 26. Yeah, there you go. So number 3, how much did cyber attacks on utilities increase in 2023? A, 50%, B, 200%, C, 400%, or D, 500%?
Yeah, I'm curious how many of these are. I mean, how many cyber attacks are publicly disclosed too? Curious where the data source is, but I think a lot of times, it doesn't make it to the public news.
Yeah, that's a good point. We did a podcast, gosh, it was end of last year, but we were talking about both physical and cybersecurity attacks, and it's amazing the types of things utilities are having to address these days. It's shocking, just how dynamic and devastating that can be. All right, so the majority voted 200%, and I actually forgot the answer. Do you remember that, JT?
Let me check.
I deleted the answers thinking
It's
that I would know
200%.
exactly what it was. Good. Okay.
Yeah, that's right.
So the majority wins. The majority wins. Good. David, you want to kind of give us your view on what you're seeing there and what the risks are?
I think the testimony of Christopher Wray, FBI Director Christopher Wray, recently before Congress heightens the importance of this issue. A number of years ago, the Wall Street Journal had a report saying that there are foreign governments, foreign actors who are already in the control rooms of different electric utilities, and some of those that they cited were cooperative utilities. The cyberspace is a very difficult space to get one's hands around. One, because the bad actors, which can fall into different buckets, are very ambitious people or very motivated people in terms of finding ways to wreak havoc, whether it's for financial gain or to disrupt society. In terms of getting one's hands around it, like NERC, their SIP standards, the critical infrastructure protocols, they're not saying that like you need to do this, this, this. They'll go into examine a utility and say, we think you're doing something sufficient, but you don't know until you're hacked whether or not you have sufficient protections in place. And if you think of like back many years to the hack of Experian, like you would think they have so much critical data on Americans that you would think that they would be hyper vigilant, and yet they were hacked. In speaking with utilities, we look at the NIST cybersecurity framework, and we look at Are utilities being proactive? Are they prepared to respond to attacks and recover from attacks? But one of the things that makes it very difficult in terms of making assessments in the cybersecurity space is that there is a concern by utilities that if we share what exactly we're doing and it should get out, what it is that we are doing, that the bad actors are going to infer this is what you're not doing and see and find vulnerabilities. So again, going back to FBI Director Wray's comments, that this is a real vulnerability, not just for the electric sector and their revenues, but without electricity, commerce comes to a stop and our way of life is at risk. And hopefully through NERC's audits and utilities vigilance, the electric grid will be protected.
Yeah, you certainly don't want to give away your playbook, but David, kind of curious, what's the most kind of significant cyber attack you've seen? I know there was the one outside of the U.S., like Ukraine, back in 2015 to the utility, but what's the most significant? And another one, not utility, but the well kind of publicized attack on the Colonial Pipeline.
Sure.
The oil pipeline, which shut it down for a few days and kind of wreaked havoc, the gas stations on the East Coast. But yeah, what have you seen in terms of recent history or history in general?
So we're seeing healthcare systems are being hit much more than electric systems. We're seeing also water sewer systems are vulnerable. I think there's less sophistication. The EPA just came out with a report in the past few days where they cited water systems as water and sewer utilities as being particularly vulnerable. And maybe there's less sophistication. They don't have a NERC to provide protocols in terms of cybersecurity, and perhaps for the bad actors, the water and sewer utilities are a place to test their skills to see how to breach. The water and sewer utilities aren't as interconnected, or if at all, as are electric utilities, and we see for electric utilities that this is an issue that is a very prominent issue, but a very difficult issue to define exactly what one needs to do to protect the system.
And do you all typically look at S&P in terms of insurance coverage for these types of events, or do you dig that deep?
So we do ask about cyber insurance. We don't publicize the amounts of cyber insurance because that would be a motivating factor. Oh, they have X millions of dollars of cyber insurance, let's hack them, and we'll go for the policy limits. But in terms of liquidity and recovery, that's an important factor. You mentioned Colonial Pipeline. There, the rating did not change, even though the hack was so disruptive, but the size of the company was such and their balance sheet was such that they were able to absorb the costs of the several days that they were offline due to that incident.
That's great feedback, David. And I think we've only got a couple of minutes left, so I thought if we don't see any more questions come up, I might wrap up here. But we've talked a lot about headwinds here, and I think there's a lot of value in really talking about this as a group, thinking through how it impacts utilities. But I think there's also a lot of really strong tailwinds as we think about opportunities, especially in the electric co-op space. So I don't want anyone to walk away thinking that it's all negative. JT, any sort of closing thoughts around your view when you think about a broader portfolio in the infrastructure side and what we're seeing specifically with co-ops and the opportunities that they have in front of them?
Yeah, and I think the load growth, David mentioned a long period of kind of stagnant load growth. I think load growth is a tailwind. I think the data centers are a tailwind if executed properly. I think new era is a tailwind. I think it's exciting to be part of the infrastructure platform here, because not only in the utility space are we seeing a lot of, growth and capital spending and therefore opportunity, but on the digital infrastructure side, we are as well. The water side, we are. So it's really kind of across the board. There's opportunities for us to serve our mission, to make a difference in rural America. And yeah, just being part of the transition, I think it's an exciting time.
That's a great summary. I just want to thank our panelists. Lots of great information and perspectives here. I think it's really given everyone something to think about and ways to go back to your maybe boardrooms or to your management teams and say, here's what we heard. Here's how we want to approach this, right? And so that was the goal. I again, thank you, David. Thank you, JT, for your time. Thank everyone for participating in the chat, for voting. As Paul mentioned, the slides and recording will be available after. And don't forget to fill out the survey if you want to do the CPE credits.